Hello and welcome to the market update for Tuesday, October the 11th. If you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at traderspro.com. I'll be happy to answer those for you. Also, if you miss a class and you want to review a recording of the class, you can access that on YouTube. Go to YouTube. Search for Traders Pro, the Traders Pro channel. Not only does it have the market update, stock specific class recordings there, but there's also some trainings. I got a lot of training videos on that channel. Almost everything, pretty much everything I teach or talk about is I've got trainings on it. Now it's important though that you understand that the first part of the training video is I did these a couple years ago. The first part of the training video is a market update or a stock specific class, and then I did the training. So you'd have to fast forward about halfway or so through the class to find where the training is. So it's a little bit of work, but that information is there. If you need it, it's a matter of how much time you want to put into going through that. But if there's something I talk about, a technique or something I talk about in the update that you want to learn more about, just go on to there, like candlestick formations or ABC patterns or Fibonacci retracements. If I talk about Fibonacci retracements, there's trainings on all that. Elliott wave trainings on the YouTube channel there. All right, let's get started. Big reversal today. Market started to sell off early and then has reversed back up. I'm wondering if it's going to last or if it's going to hold, because it's at least the reason behind it is based off of one of the Fed presidents possibly making a dovish comment. It's getting ridiculous now, where people are I swear they're looking at not only what words they're saying, but how they say the words and what was their facial expression when they said the words, and that's how ridiculous it can get sometimes. But you have to. It's ridiculous, but you have to respond to it, because the market if the market's moving, you gotta, and it's based off of something ridiculous, it's still moving. You gotta just kind of shake your head and go along with it. Especially as a trend trader, we're not trying to predict the trend. We're trying to follow the trend as best we can. But there's also an area here where we could rally a little bit. We're back in kind of a no man's land area. We'll look at the chart here in just a second. Where the market is getting oversold, but it's not extremely oversold yet. So it could bounce a little bit here, but it could also, we're right at that critical support level near those June lows, where it could collapse right here. We could have that panic sell-off, and so it makes it very difficult to trade, because it could go either way, and you could make an argument, almost an equal argument either way, that it could go either way, that the market could trade either way. So you feel like you're flipping a coin, that you're guessing, and anytime I start feeling like that, or start to sense that that's the type of market I'm in, I usually like to sit out and wait. Usually those periods of uncertainty don't last very long. It might only be a day or two, or maybe a week. Usually it's not more than that. Usually it's not more than a day or two before something clicks and it starts to become a little bit clearer what direction the market's moving in. But usually that's a sign to me to kind of sit tight, not do anything. Or not do too much. Doesn't mean you don't have to do anything, but you don't want to get too aggressive in that type of condition. As we go through the direction alerts, and again, these direction alerts they're trying to show you overbought or oversold. That's the main use for these signals, or the direction alerts, is to indicate overbought, over. Let me give you an example here. So let's say this is an uptrend right here. Some of the indicators are trying to tell you what the trend is, okay? And this gets back to the chart itself. Usually it's the chart itself you can look at. Is it reaching higher highs, higher lows? But then what you also want to be aware of, though, is where are you at within the cycle? Because you might be in an uptrend, but you might be overbought, meaning it started to move up a little bit too far, too fast, and it's good. It's probably that's where you get the reversal risk indicator. What that's telling you is not necessarily that the trend is going to just reverse and go down, but it's telling you either the trend could reverse and go down right here, or you're about ready to get these pullback. And this pullback, you're overbought, you're stretched, and then you're probably in danger of getting this little pullback. So you don't want to necessarily buy in an extended part of the trend, because you're probably going to whipsaw back down here lower, and you can have a better entry point if you were just a little bit more patient, or you can wait for that pullback and wait till it started to move back up again. That's a better entry point into the next move. You're trying to get into the next move higher. And so again, we're never going to perfectly do this. We can't perfectly know when to get out, but so it's all about probabilities. What are the probabilities? The probabilities of getting in right here is you're probably getting in right when it's about to pull back. Now, a lot of these indicators with the market dropping are getting oversold. Now, we're in a downtrend now, so when we're looking at overbought, oversold, when we're getting oversold, it means we're probably getting stretched to the downside, meaning we're probably due for a little bit of a bounce or a relief rally. Doesn't mean it's going to go into an uptrend, and I don't have any strong belief that the market's going to go into an uptrend, or that we bottom, or we're going to bottom here. I think we have a lot further to drop. I'll give you some of those reasons in a little bit, but we're at a spot right here where we're not overly oversold, but we're enough to where we could get one of these little bounces, and it might be real brief. It might be just a couple days or so, and then probably resume that downtrend. So when we're looking at these direction alerts, that's what we're looking for, is that part of the analysis of the market update here is trying to determine where are we overbought or oversold, or we're at any extreme range within the trend. Now, first of all, we got the bear market indicator. This doesn't change very often. It is worth noting that we're at the far left side of the bear market indicator, which means that we're at a little bit of an extreme level in the bear market. And I think everyone would agree with that we're probably getting close to a bottom with as long as we've been in this bear market, and as far down from the highs as we've gone. But, again, we were in a bull market, the far right side of the bull market, for like 2 years or something like that. So it can stay extreme for very long. And so you don't want to base a trade off of that alone. But it is worth noting or recognizing that we've had a pretty big pullback in the market, and we've been talking about that we're looking for now these bottoming signals. What the big one is that we're going to get some sort of panic sell-off at some point. By the way, the reason that I'm a little bit concerned about that, because that is a normal part of almost pretty much every market bottom I've ever experienced, at least significant bottom, has had a panic sell-off. And so obviously that's the higher probability outcome. You're likely to see it at some point. But what makes me worry a little bit is that everybody's talking about that. You go on CNBC, you go on any financial news place, and everyone's waiting or looking for that panic sell-off. And I have this feeling that when it happens, that everyone's going to say, okay, that's it. It's done. We bottomed, and they're going to start charging back in. But the problem is not only do bottoms have a panic sell-off typically, but also bottoms are mentally, when you're at a market bottom, nobody feels like buying. Nobody feels confident buying. It's just the opposite. Everyone's scared. Everyone is fearful to do any buying. They're not excited to do any buying. And so when I hear these people start saying, well, you can start to get in right here, and and put some money to work. And we may not be at the bottom, but we're going to be near the bottom. You can't know where the bottom is, so don't even try. Just start, starting your buying right here or what have you. I start to worry because that's not the feeling. That's not what you feel like at the bottom. You feel like stay out, go to cash. This could get so much worse, and how much worse it's going to get, I don't know. And it's just a different emotion. It's hard to explain unless you've experienced it. And that's why I want you to pay attention to these next few months. Not only your own emotions, but the market emotions, especially if you're new to trading, because it'll become when it does happen and however it plays out, it'll become a foundation for you moving forward to where you can recognize those same things again in the future. And you'll understand why. I've been through a number of these now. I've been through two major bottoms, and they don't happen very often, but my first one was shortly after I started trading, was the internet bubble of 2000. And then obviously the financial collapse of 2008. They seem to happen like every 10 years or so. So they don't happen very often, these big ones at least. By the way, there's minor bottoms. You can use some of the same analysis in trying to determine where minor bottoms take place. It's just that you don't get to the same level of fear in a minor bottom, but you do get some concern, or maybe you don't get panic, but you get fear at a intermediate bottom of some sort. And those happen more regularly. Those happen every couple of years or so. You'll get one of those that take place. So anyway, let's go through I didn't mean to opine so long on the open here, but let's go look at the direction alerts here. So momentum, again, you can see we're in the sell area, and it is a little bit oversold, but it's not in the extreme level. And even if it gets to the extreme, usually when it's really stretched, it'll be over here, at least to the right side of that. Usually I divide these boxes in half, meant just visually. If you start to get to the left side of that halfway point, that's really where you are close to, in this case, getting a rally of some sort. You're really oversold when you get to that area there. But where we're at right now, I mean, we are mildly oversold, so we could get a little bit of a bounce that pushes this indicator back up a little bit, or we could really get a panic sell-off that really pushes us to the far left side of that range. So again, like I said before, we're kind of in that no man's land area. Sorry, I'm getting a little congested today. It's spring and fall. Spring and fall, there's something in the air that I'm allergic to. The only good part about winter where I live is everything dies off, and I don't have any allergies for a couple months. But then it's cold season, so I'll catch a cold and then be congested. So I can't win, I guess. But here's the breadth indicator. We are in the extreme range. If you put a line in the middle of that box, we're not really into the real extreme left side of that. But again, this is oversold. Breadth is telling us the market is in that oversold area. But there again, could it become even more extreme? Yeah. So it's hard to kind of gauge from here what the market could do next. Sentiment is still obviously high, but it's backed off the extreme range. We did have the VIX spike up a little bit. We'll look at the VIX indicator here a little bit later. But there again, we're still waiting for a sell-off it's been in this high extreme range forever. We really need to get a big enough sell-off that pushes this indicator back into the fear area. Now, it'll move very quickly into this area. When it finally does, and it's kind of working towards that. The VIX has been elevated now for a while, and when it really starts to spike, it'll push into this. Well, let me give you an example of how to use the sentiment indicator here, because if you look at the VIX, what you'll notice is that most of the time it spends its time in a lower range. Usually it's below 30. If you have a VIX chart, we use the VXY here, VIXY, excuse me. It's the ETF that allows you to trade the VIX if you want to trade it. No, I don't recommend doing that. But the chart and the numbers are lined up the exact same as the VIX. So these numbers I talk about you'd want to be comparing those to the actual VIX chart. The reason why the VIX chart doesn't show up on Traders Pro is that you can't trade the VIX indicator by itself. You got to trade it through the ETF, the VIXY, and there's only tradable instruments are displayed on Traders Pro. So, but if you're below 30 is kind of the fear level on the VIX, and most of the time the market is below that. Okay. When it freaks out, it spikes up and it'll get up above 30. 40 is where it's freaking out, where it's panicky. But with some of these major collapses, I want to say that the COVID one, I think it got up to 80 or something like that. It was one of the most extreme ranges I've seen the VIX get to. I think it was around 80. But it hardly ever stayed. I mean, if this is panic and this is extreme panic up here, obviously you're not expecting it to stay in this range very long, and it doesn't. If it really gets panicky, it'll spike up in this area, and then it'll usually start working its way back down. So it's when it spikes up into that area that this is going to push into this fear area. It'll get over in this pretty quickly. So if you're looking at this like a steady rise, normal type steady rise, where this is just going to go gradually down into fear. It's not. It's going to go from complacency to fear. And when it happens, you'll see it'll shift over pretty quick. But that'll tell you, you'll know, okay, we haven't had a significant sell-off yet that has got us into the fear range on the sentiment indicator. So when you see it at that, pay attention, because that is telling you that is one of those panic type sell-offs that you have to pay attention to. Okay, so I'm doing a little bit of training in this as I'm going along, because I've had some new people join, and sometimes I get in the habit of just going over the same thing or brushing over these, assuming everyone knows how to read these, and even some of you that have been here for a while may not know how to read these very well, and so it always helps to periodically point or train you on some of this stuff a little bit. By the way, I use this stuff all the time myself through my own analysis, and what I'm going through are the same steps that I do almost on a daily basis to before I start looking for trades. I want to know what we're doing right now is we're trying to determine what the market conditions are. Are we in an uptrend, downtrend? Where are we at within the trend? Are we overbought, oversold? Are we just trending? We want to just get a feel for the conditions, so that'll help us make better decisions when we're deciding on trades. Buy-sell ratios started to come closer together here from this extreme range. We've alleviated that condition, although we're starting to move back again with the recent selling. We'll have to see how things look today, but hold on here. Give me a second here. I like to kind of peek, kind of keep an eye on what the markets are doing. And that's a long story. I just want to make sure I get that CNBC on the TV so I can, because we have backed off a little bit from the highs of the day. And we'll look at the chart here in just a second. I'll kind of go through some different scenarios here. But this started to move up with the selling yesterday, and probably, well, it hasn't factored in this morning yet, or today's possible reversal. Now, again, it is kind of in a no man's land. It could become more extreme right here. So the market's just not overly stretched right here. Although I don't know, you could make an argument. I mean, that's what this is showing right here. That's starting to move back, and that could happen very quickly. We could have another sell-off day. We could be right back up here. The sentiment indicator's not. You'd want to see this down, this little green line down here. It's not in the middle, but it's off of it. Again, just all these things are telling us basically the same thing, that we really could go either way in the near term, at least. Overall, the trend is still down, and we'd expect the trend to continue down, but they're all kind of in that coin flip area. I'm still paying attention to if you go to the index tab, right here. There we go. We are at a pretty extreme level on this, and you know, if you look at the Russell 3000 index, there's only 178 stocks. These are 3,000 stocks. 178 are buys. There's over 1,000 that are sells. What can be, we've seen it more extreme than that. But, you know, sometimes when you've seen it more extreme than that, it's easy to just dismiss this as saying it's not as bad as it was a week or two ago. That's still pretty oversold, but it's typical of what you would expect in a bear market. We're trending down overall in the market, and what we're seeing is a lot of these drops are. When we get the major drop, it's really showing us an extreme oversold condition with a lot of these. Very few stocks that are buys, a lot of them that go to sells. But then when you get these little snapback rallies, you're getting a lot of these sells that go back to hold, a few of them go back to buy. But overall, you're seeing very low ratios here, which is, again, it is pretty typical in a downtrend, a severe bear market at least, to see that. But when it gets this dramatic, you know, this is a signal that we're getting close to that market bottom when you start to see these ratios very, very low, and especially if we get a big sell-off and they get really extreme, where you're getting, you know, out of 3,000 stocks, you're getting double digit. You have 25 that are buys, and you know, 2,500 that are sells. You know, you're at a pretty extremely oversold condition. Very likely you're going to get some sort of bounce very soon. We saw that happen. Remember in that market update I did a few weeks ago, when we were really oversold, I was telling you, hey, this is telling us that we should get some sort of market bounce, and sure enough, we did. Within a day or two, we did. So again, when you start to get to extreme conditions, you want to pay attention to this as well. I don't check this index tab very often, just only when I think in a very strong uptrend, when it gets overbought, too many stocks in the buy area, you could get a pullback, and then this is the opposite of that, where we could get a little bit of a rally or a bounce off of an oversold condition. All right, let's move into our chart. It's the SPY, and you can see kind of what happened today. We opened all the way down here. So we got down at the open. Here's where we closed yesterday. We traded down below, actually, the new recent low that we put in a week or so ago. That was, I believe that was Friday. I don't want to get back trying to figure out what days they are, because I thought that was a Friday that we hit that new low, and then we snapped back from that. We had been watching for the longest time these June lows right here. We did dip below that. We backed below it again yesterday, and that's one of the reasons why I thought that we could really start selling off big today, or within these next few days, is because, you know, you break it once, you break the support level once, and you snap back. When you break it again, usually it's going to go, and that could still be the case. The overall trend is still down. and we're gonna expect it to continue to move down until it changes, until it shows us otherwise. But then, we gapped down, we started to sell off, and then we kind of reversed, and we're trading higher. Now, this is a bullish reversal candle, okay? When it does that, it opens lower, and then it manages to reverse and come up. Buyers are pushing things up right here. But this is where I'm trying to figure out why they're buying. And if it's based off of a Fed president's comment, the market is just craving a reason to rally, a reason to buy, and I just don't know when all the other indicators are indicating that we're heading to recession, and it really could be a bad recession if we're not careful. And the jobs market, the jobs report on Friday was not showing any damage to the job market, which is what the Fed wants to do. Believe it or not, the Fed right now is trying to crush the economy. It's trying to crush. It wants to see unemployment go up because that's what's going to stop the spending that is causing inflation to go out of control. It's a terrible outcome because the people that are going to get hurt the most are the ones that are living paycheck to paycheck and all that kind of stuff. But that's what we know that's what the Fed is trying to do. And so I just don't see, especially what changed from Friday to today, that's a reason to be very bullish. So I don't know if this is going to last, but again, I read price action and I read trends, and I try not to overthink things because it doesn't matter what I think. It doesn't matter what my opinion is. It doesn't matter what I think should happen or whether buying or selling makes sense or not, because it usually doesn't in the markets. It usually lacks any common sense a lot of times. So you got to be careful not to overanalyze things. But I didn't trust it when it happened today, and I still have to wait to see how it looks at the close. But it is fading a little bit from where it looked like a strong reversal when it was at the highs of the day here, but now it's starting to fade a little bit. I'll have to see how it looks in the close, because if we really fade into the close, that would be very bearish. Here's where we're at right now. If we come all the way back down, not even necessarily all the way back down, if we come back down even to this halfway point of this candle right here, then that would be very weak. The buyers weren't even able to close it at the highs of the day. This is supposed to be news that could rally the market, and especially if it rallies, if it comes off the highs of the day. And we got to really pay attention to that June low, because what used to be support can become resistance. Look at the intraday high today. Look what it did. It came right to that exact low, and then it's fading from it. So if it continues to fade into the close, then really all I would look at is this was just a test of that resistance. It acted as resistance, pushing back down, and you'd be at danger of really starting to slide from that. Now, news events, what's been a little bit of a challenge recently is that news events that have normally not been that big of a deal have become a very big deal. Anything related to inflation, the market is just laser focused on. And the problem is that immediately after that event, it immediately looks at the very next inflation number to focus on. We had the jobs, everything was on the jobs report Friday. Jobs report comes out. And the problem is that these events have been very binary, meaning if the news is viewed as being good, market's going to go up. If the news is viewed as bad, the market's going to go down. Although the jobs report was one of those weird opposite things where a good jobs report was bad. A bad jobs report would have been good. This is how crazy it gets if you try to think logically. But but the problem is that we could have gone either way. If that jobs report would have shown that there was unemployment was rising, the market would have rallied pretty strongly off of that. And it becomes very hard to deal with that, especially as a trader. Investor, you're not trying to pick tops or bottoms as much. But as a trader, it's very important to try to read these things. And so it's hard when these events are having an impact. You get it. It creates kind of that coin flip type feeling. Now, it can help if you're at an extreme range. If we're really extremely oversold and there's a news event coming out that everyone's focused on, chances are the market's going to rally off of that event. Even if it's bad, it's considered bad news, the market is already so extremely oversold. That rubber band is already stretched. It's likely to snap back the opposite direction. So it's easier to trade when there's a news event and the market is stretched in one way or the other. Usually that even if it has an initial reaction, if it drops a little bit off of the news item, it's probably going to snap back because it's so oversold. We're not oversold enough, though, right here to where I feel real confident. And the point I was going to make is Wednesday, tomorrow, you've got the FOMC minutes that come out, the Fed minutes. So you have the Fed meeting that happens, and then 6 weeks later is the minutes that get released. And the market has had major reactions to the Fed meetings and when the minutes come out. So we'll see if that happens. Thursday is the CPI report, which is an inflation type report. So you got these two big events that are happening in the next couple of days that could move the market. It'd be easier if we were really oversold. I'd say there's a really good chance that we're going to bounce right here, but it's hard. It's hard to know which way to go. Now, we already talked about if this fails right here, could we really drop? I think if we really start dropping right here, we could get that VIX to spike above 40 and get panic in the market. It's been trying to hold on to those June lows for a while right here, and at some point it's going to slide. But there's another possibility, and it would probably just be very short term. You saw this little bounce. This is a 2-day bounce right here, and then it continued to drop. Same thing could possibly happen where this is maybe wave A. This could just be maybe a correction within this trend. Obviously, this trend is down. This could be wave A, wave B, wave C, a bearish ABC pattern, and then it continues to drop. And that this type of scenario is interesting because a rally right here, 2 or 3 day rally, would alleviate the oversold condition, but that's all it would do, and then you'd probably have another free fall. That could also be, especially since we have those two reports coming out tomorrow and Thursday, that could be enough of a snapback rally off of those reports. And again, nobody knows what those reports are going to say, and I don't think those reports are going to change the overall trend of the market. So it would probably be very short-term reaction. But that's another possibility I'm looking at, is this is just an ABC correction. Now, it looks a little bit more likely that could happen when you look at some of the other indexes. If you look at the Dow, for instance, the Dow has not retested that recent low. So let me go back to the SPY chart if you didn't catch that. So if we go back to the SPY chart, today we actually moved below that low in the SPY, below this low right here. We've come all the way back down to it here, but we haven't gotten all the way back down to it on the Dow. The Dow's held up a little bit better. And these are the larger companies, and that's where people are moving. They're definitely not in risk trades. So the small caps and riskier trades they're moving out of those and into companies they know that aren't going to disappear overnight. But you can see that, and the Dow percentage-wise is up much stronger today. In fact, it's moving above yesterday's high. Now, this is most of the time when we're looking at the indexes, we're just looking at the S&P, and then we kind of brush over the Dow and the NASDAQ and the Russell because they're usually saying the same thing. But this this is a time when you can look at each individual index and maybe it could be hinting towards a more likely outcome. We got a coin flip area right here. It could go either way. The Dow is actually leaning more towards a bounce right here, or a rally. The way it's behaving, especially if it closes above yesterday's high, that'd be a bullish. You got a bullish reversal candle, and if you close above yesterday's high, there's probably a good chance you're getting a little bit of a bounce out of this, and that would play into that ABC, that bearish ABC pattern scenario. Get a little bit of a bounce, and then you continue the downtrend. That would play into that a little bit better. The NASDAQ, see, it's done the opposite. It's gone lower. It's been beat up even more. So the NASDAQ is actually pointing more towards that bearish scenario. It's not helping now. We're getting into it's making it worse. The coin flip is getting worse, because here it broke through. It went lower than last week's, or that was 2 weeks ago, that Friday low. Kind of like the S&P chart, except it's gone lower than, clearly lower than that. But it retested that area right here, retested it, and it's really a compact. This is an indecision candle right here, as it looks right now. Now again, this could change going into the close. So a lot of this, I do all this analysis, and then that's what's happened a lot lately. Is we've spent an hour going through all this analysis, and then that candle changes 5 minutes before the market closes. It looks completely different than it did in class. So that's just usually that's not the case. Most of the time around this time of day, or at least by the end of class, you're not going to get too big of a change in that last hour. A little bit. Obviously, the market moves in the last hour, but typically it's not going to change that dramatically. But lately, we've seen candles that have looked almost completely different at the close. But the way it's trading right now is showing just indecision. And whenever you look at indecision, the previous move becomes more important. If you're running down a hill and you stop, where's the path of least resistance after you pause? It's to keep going down the hill. That's where that momentum is. It's going to take a lot more energy to reverse and start going up the hill. Now you could reverse and go up the hill. The market could reverse and go up right here, but typically when there's indecision, you hear me talk about this all the time. Whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moved sideways. That's where it's likely to go after it's done moving sideways. And again, the key there is likely, and after it's done moving sideways. It doesn't have to, but that's the probability. It's more likely to continue in the direction after those pauses that happen, in the direction it was moving in before. And so when you see indecision, like if it stays like this, you see indecision and the previous move has been down, then I would assume that that it should continue to move down. Although, it's still kind of a coin. Well, it's a coin flip because we're dealing with two different candles and two different indexes, and one is looking more bullish, this is looking more bearish, and not helping. Russell, what does the Russell do? Is it going to help us at all? It's not helping too much. I mean, you do have a little bit of a bullish reversal candle. It didn't go below this low. It's held up below. So it does look like it could be kind of that ABC, get a little bit of rally and drop. You'd like to see a close, though, above yesterday's high right here. If it could close above that, that would maybe tilt things more towards the bullish argument, because now you got the large companies in the Dow, the small caps, both looking like they could rally, and that might lean me a little bit more towards thinking we could bounce a little bit. Yeah. Good news is these periods don't last very often, but it's good to have a class like this, because when you are doing this analysis and you feel like pulling out your shiny gold dollar coin and flipping it, it's it tells you shouldn't be doing a whole lot. Shouldn't be very aggressive in this type of condition right here. Now, you could make an argument too, if you're really trying to be bullish, you could make an argument that, go back to the S&P chart, go to a 2-year, let's go to a longer term chart here. Because one of the things we talked about a few weeks ago was that, and this is what I think is playing out, is that this was wave A, this rally is wave B, and that we're in wave C. The problem is, and we have gone below this low right here, which is usually what wave C will do. If that's wave A, wave B, usually wave C will go below the end of wave A. But that's a really short wave C in the usually there's going to be proportion, at least some proportion, most of the time, not all the time, but most of the time wave C is going to be about the same length as wave A. That's one of the things I look for in ABC patterns, and the keyword is about. It doesn't have to be exactly the same length, but this is why I think we have a lot further to drop, because if that's wave A, then wave C to be about the same length as wave C means we've got to drop a little bit further down. But could this be a case where wave C is just a short wave C and that we're going to start coming all the way back up? Yeah, that's where we get it. That's where the problem is. You start getting in the argument of, is it possible? Well, yeah, there's lots of things that are possible, but if you start focusing on the possible in the markets, you're going to get killed, because everything's possible. You got to stay to probable, and typically ABC patterns don't complete with wave C being that short. And in this case too, we can also add that typically, again, what else would a bottom feel like too? Well, you got to get the panic sell off. You got to get, you got to be fearful to be buying in. And we don't have that yet. So that tells me we'll probably have a lot further to drop. And so to make an argument, this is the bottom and we're going to rally up from here. Now, could it be, this would look a little bit more logical on on a NASDAQ chart. So let's go to the NASDAQ chart here. Let me show you another possibility. Could it be that, actually maybe it looks better, more logical on the Russell chart. Yeah. Could it be that this is wave A, this is A, B, C for wave B, and then you get wave C, big long wave C. Yeah, that's if we had an extended rally where we rallied up quite a bit, that's what I would be looking at as a possibility. But we don't want that, because that means that we're months and months away from the bottom. And if you're like me, it's like, let's just get this thing over with. I want to get back to, I want to start getting excited about putting money to work, and instead of sitting on cash and doing nothing. But we can't always get what we want, so we'll have to be patient. But that would be another scenario, and we can talk about that if the market just starts taking off and rallying, and what else could it be if it starts to do that. But everything really, every time I look at that chart, the S&P chart, it just, there's really nothing about it that looks like it's at a bottom or is going to rally from here. Anything other than just a short 2 or 3 days relief rally. And that's going to happen within these trends. You're going to get these, look at the whole downtrend here on the Russell. You had a 2-day rally here, a 4-day rally here, basically a 2-day rally here before it reversed again. It's like they're short, and they're short and big, but they typically don't last very long. And the market could, or in a downtrend, any day it could do that, where it snaps back, but it's not likely to last. Okay, let's get through the other ones. TLT, a little bit of a rally today. In fact, a lot of the news today is focused on the bond market. Bond market was closed yesterday, so it could be a little bit of an overreaction to not being open yesterday when the markets were open. That doesn't happen very often, where you get the bond market is closed and the stock market is open. market hates that because it gauges a lot of the decisions that these big, not the normal trader, but the big institutional traders, that they're trading usually stocks and bonds, and so they're following both markets. And when one of them's closed, they don't want to do too much. And so today could be a little bit of an overreaction to just the bond market being closed yesterday. But clearly we're still in a downtrend on bonds. So what is going to be the key levels to look for or watch for? Well, obviously, I've talked a lot about this area right here, but we did go, here was a lower low. We did bounce off of that lower low, and now we've gone to another lower low. So when that happens, when you've gone to that lower low, you want to take what was the lower high before that lower low right there. So it was this up here, but now that we've gone lower, yesterday move went lower. This area is now the lower high. So that's going to be significant right here. That will be, if we rally up and break above that, that will be going to a higher high. Then you look on the pullback, does it have a higher low? And that's when you start just talking about a possible trend reversal. Until then, whatever, this rally is going to be viewed as just a bounce within the downtrend until it can get above that area. And so, just we were doing the same thing back here. We were looking, when we had, this was a lower low right here. So that was the lower high right before that lower low, the previous lower high right there. It started to rally a little bit, but it couldn't go anywhere. And then it reversed. We're assuming the same thing here unless it can get above this level right here. And yeah, I know that's real simple to just kind of, but that's the first thing you need to see for a potential trend reversal is are you starting to go do you have even the possibility of going to higher highs and higher lows, and that would be going to a higher high right there if it can break above that. But again, trend is still down. We're assuming it's going to continue to move down until it changes. Gold, if gold could have broken above here, there was the lower high on gold right there. Actually, no, it did go lower to this is a lower low, went to another lower low. So it did break to a higher high right here. And then you can wait to see if that puts in a higher low, a little bit of a bullish reversal candle today, see if that rallies off of that. It can put in a higher low and start moving back up towards here. That would be potentially a trend reversal. If it can break out, if it can rally off of this and break out above here, that'd be very bullish because that would then put in a higher low. You did go to a higher high right here, and then you're going to another higher high. So now you're getting higher highs, higher lows. It's acting like an uptrend. So what we're watching for in gold, if you want to, if you're trading gold or anything, is does that hold as a higher low? Because it could, it's just a little bit of a bounce today. It could reverse and just keep dropping, go to a lower low right there. But if it can hold and start moving up, it would establish a higher low, and then you'd want to see if it could take out these highs right here, and that'd be pretty bullish for gold if it could do that. Oil, kind of very similar with oil. Oil, it has broken. This looks impulsive. Not a lot of choppy back and forth in that move, and so it looks like it's rallied back up. Now, I've talked about this, and again, some people might disagree with when charts are in kind of gray areas. You can have people disagree a lot of times, and again, people that are very good at technical analysis could disagree on trends. Because just like today, we got a market that can go either way, and even all the technical analysis we're trying to apply to it, you can make an argument the market's going to rally for the next few days. You can make an argument that the market's going to collapse right here. Well, who's right? Well, who knows? It's a coin flip area. So but you could grab onto another reason. And so if you see disagreements between traders that you follow, it's not always, it shouldn't always be an argument of who's right, who's wrong. It's in fact, I would argue, pay attention to both analysis. Maybe there's something in that you didn't think of, or that might sway you in a direction. Or what should happen is it tells you really need to be on the sidelines because you're in the coin flip area. But what I'm trying to make is that there's good reasons to believe that oil could continue to move lower. You say, well, I believe this is the peak in oil. This is a move down. Here's a pause right here. Here's another move down. This is just a rally within the downtrend, and it's going to keep moving down. And to be honest with you, until it gets above here, that argument is still intact, because this is a downward move. This could be that little pause. Another downward move. This could just be a rally within the downtrend and reach a lower high and lower low and all that. But the way I'm looking at this is that here's your long uptrend right here, and this looks like a wave A, wave B, wave C. Now, this would put wave C a little bit on the shorter end of wave A, but remember the key part of that is that wave C should be about the same length as wave A. Doesn't have to be exactly. It could be a little bit shorter, a little bit longer. But I think when I highlight this, you can see a little bit there. You can see that it's a little bit shorter than wave A, but it's about the same length as wave A. It's not too short to where it's like, yeah, that's really short. So that could be the correction. And if that's the case, then what you should see out of that is you should see an impulsive move up, and we should start to work our way back up to new highs. Now, it's not going to go straight up. And so what we're observing right here, what you have a lot of times, the basic trend analysis really focuses on what we call fractals. The market moves in kind of a fractal type nature, where you have these bigger stair steps, and that's what we're analyzing right here. Is this big move up, this big step, this next maybe big move up. I don't know how much more oil is going to go up higher, but you get those bigger stair steps, and then within those larger stair steps, you get these smaller stair steps. So these smaller stair steps are building these larger stair steps, which are building even larger stair steps. And you can see this when you look at different time frames and charts. You can see this kind of play out. But it's important you understand that concept, because it's huge in technical analysis to understand how trends move. So overall, I think that this is a larger correction, and this is going to be a larger move up. And it may not go much further than a new high, but I think eventually it'll break out to a new high, probably sometime in January, February. This plays into the chart is looking this way, and then you look at the fundamental argument, which I don't put a huge emphasis on, but you have to pay attention to it, which is there's an energy crisis, and we're going into winter. Europe doesn't have a source of energy, a very reliable source of energy to heat themselves through the winter. And I know we've been aware of this now since Russia invaded Ukraine, but it's a problem that doesn't solve quickly. You don't suddenly turn on a faucet and there's your oil problem is done. People have been working on this for the last several months, and it's still a problem, at least everything that I've heard. So my argument would be that could be enough to push oil to new highs. I'm not locked into this to where if it suddenly reverses and sells off that I can't follow it down, because that could happen too, where suddenly OPEC decides they want to flood the market with supply of oil because that's what they love to do, right? Is oversupply and cause the price to come down. But anyway, so that's and the reason why I'm saying this could line up to January, February is because then that's when the market's always forward looking. That's when you're going to be starting to move back into spring and summer and won't have as big an issue then at that point. So, and you can't have oil. If oil is going to go much higher than this, then you're talking about, we already saw what happened when gas prices were where they were a few months ago. It's going to, and you add that to unemployment now, that could be really, really ugly. So I can't see, it's hard for me to see oil going too much further than that. That's just, all I'm looking at right here is just, can it get back up to this high or go a little bit higher than that? I think there's definitely potential there for it. Now, in the near term, though, we've already had a little bit of an impulsive move up, and we're down a little bit today. Is this just going to be, could this just be a little bit of a step within this? So you have this move up. Could that be wave A? Maybe you get wave B, wave C, and then it continues to move up. We're due for a little bit of a smaller step right here after this run. Maybe that's happening right now. We'll see. May not happen. Here we only had a little bit of a pullback and it went right back up again. But really the key area I'm focusing on that would make it, and you can too if you want to, if you really want to know when is a much higher probability that we could get back up and retest these highs, it's right here. We break above that level right there. And that was the lower high, lower low, and then that would put us to a higher high right there, and make it much more likely that eventually we'd work our way back up there. It would probably do so, like I said, in kind of a stair-step fashion. And some of these steps could be long sideways moves, like something like that, But I think it's working its way back up. So, and it makes sense that the oil trade's the only one that's really worked for us, it seems. But this is that, if you're looking for trades, you want to be in something that's probably something oil related, is probably where you'd want to be in right now during this bear market, because that seems to be the only trend that has been pretty consistent. The dollar is down a little bit today. It's off the lows of the day, though. We'll see how that looks. We've been looking at this as the correction right here, and then expect the dollar to go higher. There's always a chance that the correction lasts a little bit longer. Maybe that's wave A, wave B, and you get wave C, and then it continues up. Get a bullish ABC pattern. That's always a possibility that you have to look at. And that's the first thing I was thinking of when it started moving down today. But we'll see, because if it comes back up off the lows, and then maybe that's just a little bit of a, here's a pretty big move for a few days right here. Maybe that's a little bit of a pullback and you're back to going higher again. Definitely, if you break above here, you're continuing the uptrend. You're probably not in that correction anymore, or the correction's likely done. But if it starts moving down from here, that would be the argument. And we'll be able to look at this on Thursday too, but that would probably be the argument, is that that's wave C, and then it's going to continue. I don't see anything that's going to break the dollar trend just yet. It should continue to move higher. And that could be something that puts a little bit of a, if it continues to move higher, that could put a little bit of be a little bit of a problem for oil going higher and gold going higher, because there tends to be that inverse relationship with the dollar. All right, here's the VIX. Obviously moving up, but I'd like to look at the other VIX chart, the actual VIX chart. So let me bring that in. Ooh, boy, we have reversed completely. So there again, let's go back and look at the, sorry to do this to you, but let's back and look at the SPY real quick. It's just as we're talking, it's faded quite, and that's not even showing it, because this is a little bit delayed. It's already, everything's gone negative again. Wow. Dow was up 300 points, and now it's negative. So you see, that's the reason why I wasn't trusting the rally. It's like, what are we rallying on right? It just didn't make a lot of sense. So this actually makes perfect sense now, because I just didn't see why the market was reversing that strongly. Now, I go and say that and watch we rally into the close, and it makes me look like an idiot. But yeah, the VIX looked like this, where it was trading down below, lower than where it opened. Here's where it opened. It'd come all the way back down when that market reversed. Now it's at the highs of the day. Now, although I want to spend a little time right here, because we're in an area on the VIX that we've been at a number of times, and every time we've been up there, it's led to a rally. The market spiked up there and then rallied. It spiked up here and then rallied. And when I say, I'm dropping right here saying market rally, because the market's going to move opposite of the VIX. So spiked up here, and as it dropped, the market rallied. There was the June lows right there, spiked, and then we rallied. And now we're back in this area. So every time we've gotten up to about that 35 area on the VIX, we've tended to rally. So if you wanted to make a bullish argument that we're going to rally right here, I could understand. I could see where you could come up with that, saying, well, the VIX, every time the VIX is 35, it rallies off that. Well, the opposite argument would be, eventually it's not going to work, and we're going to get that panic sell-off. Again, we're at this critical spot. This is an area right now where I could see us spiking to 40, and it's going to get there very quickly when it does. What's going to happen? And I don't know if it's going to happen this week, but what's going to happen is you're going to wake up, you're going to see the market open. When you know that it's that flush out sell-off, you're going to see the Dow down 2,000 points, and the reason why I'm saying, or at least 2,000 points. Why? Because many of you probably have never seen the Dow down 2,000 points before. It used to be back. I remember when the financial collapse hit, we had never seen the Dow down 700 points. This is back. Obviously, percentage levels are different from that 12 years ago or 14 years ago, whatever it was. But at that point, nobody had ever seen a 700, 800 point drop in the Dow. And when that happened that day, we were just staring at the screen saying, holy crap. Well, obviously now $800 moves, 800 point moves are nothing for the Dow, or I shouldn't say nothing, but percentage, that's not a huge percentage move anymore, as big a percentage move as it was back then. But it'll be something like 2000 in the same context. It'll be something like the Dow down 2000. You're just sitting there going, wow, this is bad. And that VIX will spike up above 40, probably go well above 40 on something like that. Now, again, I'm not saying that's going to happen this week, but that's what's probably coming. And that's when you'll know, that's when you'll recognize it. That's when you'll realize why it was important that we stayed in cash, mostly in cash in the portfolio. Because that is why we're doing it. We don't want to be in it. We don't have our capital at risk when this thing breaks loose, and that's why we're using some of these inverse ETFs to hedge the trades that we are in. Because if it happens that we're waking up one day and that's taking place, what we lose on the other trades is going to be made up with what we have on those inverse ETFs, and we're going to still be okay. So if you can look at a VIX chart, this is a coin. This is still we're in a coin flip area though, because right here where we could see the market rally. This could even just come down to here and then spike, but we'll see. We'll see how things really look. If we really fade into close bad, it could be really ugly tomorrow, especially because it tried to rally so strong today and couldn't. That's a pretty weak sign. There's a note here to look at the Qs, a question here to look at the Qs. Yeah, it's back down. That's probably might be near the lows of the day or getting close to the lows of the day. We'll see. All right. Chip stocks, SMH, it's gone lower, so it's not showing that's not showing a bullish sign right there. Chip stocks tend to be a leading indicator as well. By the way, I got stopped out of that on semiconductor. That trade didn't last long. Okay, it didn't hurt us too bad, but in the portfolio, we'll look at that here in a second. But I don't think I'm going to jump into any tech stocks again for quite a while. So transports really aren't showing us anything that we haven't looked at with the Dow kind of was looking like a bullish reversal kind of where that could be a wave C. It's not really showing us too much right here as a leading indicator. Bitcoin still down. It's just kind of moving sideways and has kind of moved below this support level right here. It just really hasn't dropped too dramatically yet, but I would assume that it's going to continue to move down, bearish on Bitcoin. And then we've been keeping an eye on the high yield corporate bonds. This is what I wanted to look at here. Yeah, so we were having at the highs of the day, it was forming a bullish inside day. So you had the big down day yesterday, and then it opened higher, and it was looking like it was going to close a little bit lower. So it was going to close within the previous day's candle. That's a bullish reversal price action. Except now we're fading into the close, and really where we're at right now, you could still call that a little bit of an inside day. If we close higher than where we opened, that could still be an inside day, but it'd be a very weak inside day. I wouldn't want to assume that that's going to go up off of that price action. Again, it just depends on how things look at the close. If it comes all the way down and closes lower than where it opened, that'd be a very bearish price action there. But the market has really been focusing on the HYG, and so that's why we're looking at it. And if it manages, if we see a rally into the close, and this is a stronger bullish inside day, that would lean me a little bit more towards the camp of getting maybe a 1 or 2 day bounce, or a little bit of a bounce day out of that. All right. Spent an hour talking about basically coming to a conclusion that you could go either way right here. And now actually this slide back down I think is pretty significant. If it holds, it's pretty significant, because that rally earlier today was really sharp, and if it would have held, it would have been a much higher probability we'd move up over the next couple of days. But when it does the opposite, it's pushing us more towards that we're going to continue to drop right here. All right. Portfolio. I stopped out of, let's pull up on semiconductor ON. And again, what I was looking at was that it had held up pretty well, actually. You had this big upward move. This looks like A, B, C right here. Now, one valid argument you could have made is, well, Jerry, why didn't you wait for a buy signal as additional confirmation? And I think I talked about this last week, but if I haven't, I can't remember the last time I talked about this, but on some of the recent trades, I haven't been waiting for the buy signal, because we're not in a bull market where we're going to typically get several days where we're moving up. A lot of the trades I'm trying to do right now is just can I get a move for a few days? In this case, what I was just trying to see is if we could rally back up to these highs up here. I'm not looking to really expect this thing to go into a long extended uptrend until we bottom. I'm not expecting on almost any stock, except for maybe some of the oil stocks that have been trending up for during this bear market, trending up pretty well. But it reversed almost immediately, and my stop was down below here. I got stopped out on Was that yesterday I got stopped out? Yeah, I think it was yesterday I got stopped out of that thing. Anyway, so I got stopped out. Probably won't be looking to get back in. But there again, could this still be kind of an ABC and this is just a C leg and it wasn't done yet? Yeah, that could be the case. And where it's at right now, you're at the far left side of that extreme reversal risk. So what this is saying is that it's due for at least a bounce right here. It probably needs the market to to rally a little bit with it to cause it to bounce, but it's stretched. It's stretched to the downside, and but I don't see a reason to jump back into that. So I got out of that one. Luckily, again, I'm still holding these inverse ETFs that are the SARK and SOXS. I was actually thinking of possibly getting out of those, and it still might be the case. We rally somehow into the close, I may get out of one of them. I think I'm going to hold at least one if it does rally into the close, just to make sure I'm hedged in case it falls apart somehow. We got those news events the next couple of days, and again, too much uncertainty there for me to want to not be hedged. Northrop Grumman broke out was looking really strong, and it's backed off the highs, but this one's still been good. I like this. If you saw 60 Minutes over the weekend, another story. If you heard one, I can't remember one of the updates last week. I talked about this because I had read an article about Taiwan and supplying. There's a movement to try to supply Taiwan with weapons on the islands in case they get invaded by China. They've got to be able to fight off the Chinese until we can help them, until we can scramble to help them. And they're in the 60 Minutes show last Sunday talked about how they're severely, well, not so much severely undersupplied, but undersupplied with the things they really need. They don't need more planes or boats because those are the first things the Chinese will take out, and it'll do them no good. They need the small weapons and missile launchers and things like that. And so anyway, the 60 Minutes article or segment talked about how they're trying to buy these weapons, but they can't get them. That every country wants these weapons right now, and they're on back order. They can't get them fast enough. So I don't know what that does to you, but I'm thinking in my mind, okay, these guys, these companies that supply weapons are going to be, they've got a money machine for years. They're going to be making lots of money for years. And guess what? Everybody wants the weapons right now. Demand is high. They can raise the prices to raise those margins. I don't know. It just seems like a no-brainer to me, but this is definitely an area you want to consider, because if there's going to be a bull market in anything in the near term, it's in weapons and oil, and that's where you want to have some exposure if you're going to be exposed to something in your trades. That's where you want to be. So that's what we have in the portfolio, and that one's doing pretty well. It's had its ups and downs. It's not taken off like in a straight line, but I think that's coming. I think when the market trend starts, the market bottoms, these stocks are really going to fly in the next few years. I've got natural gas exposure with LNG. This one still looks good. Had a little bit of a sell-off yesterday, and it's off the highs of today with the market fading a little bit. But this was based off of thinking this is that kind of bullish ABC pattern right here. Typically, wave B doesn't go beyond the beginning of wave A, but there are cases where it can. It just doesn't. It'll just barely go above it, though. If you're trying to draw an ABC pattern like this, oh yeah, that's wave A, wave B, wave C. No, that's not, because if it does go above the beginning of wave A, it'll barely go above it. And that's about as much as you'd want to see it go above it right there. If it goes beyond that, then you got to look at it as, no, this was the correction, this was the trend. This is probably a trend reversal. This is probably an impulsive move down that's going to lead to a bounce, and you're heading down. So, and could that be the case? Well, you could have made the argument down here that still could have been the case, that maybe this was the peak, and now it's going to stair step down. But now that it's all the way back up to the highs again, that's a bullish ABC pattern right there, and we should see natural gas break out higher. My stop's all the way down here, so I've given this trade a lot of wiggle room to move higher, so I'm not too worried about getting bounced out of this one. I've got oil refinery and MPC down a little bit, but this is based off the highs right here. Then this nice move up. This looks like a bullish ABC pattern right here. Well, it is, because we did break out higher. That was a bullish ABC pattern. We broke out higher. Now, could this come back down and then go up? Could this be a smaller correction and then go higher? Yeah, it could, but my stop's all the way down here. If it gets down below here, I'm wrong. And that's where I want to get stopped out, is where I'm wrong. And that's where I know I'm wrong at that point. But until then, it could bounce around back and forth. But I think ultimately it's moving higher. SARK, I was thinking about maybe stopping out of this one, because it was down. Here's where it opened, and here's where it was trading when the market rallied. It was getting a bearish reversal candle, and that's what I've been doing lately with these inverse ETFs. Is we're using them to hedge when the market drops, but if the market starts rallying and they're showing bearish reversal candles, usually I'm jumping out of them. I'm jumping in and out of these. I'm just trying to use these to hedge those long positions. I want to make sure that if the market drops, we're not losing tons of money on the long positions of the stocks we're owning, that we're offset a little bit. And it's caused us to just kind of grind higher. Where are we at right now? We were at 132,000. We're now around 135,000. We're making a little bit of money, but we're giving some of it back sometimes when the market rallies. But we're kind of grinding higher right now, and that's okay. Because the other thing we could do is do nothing, and just sit out, and then these classes would be really boring. But we're not trying to get too aggressive. We're trying to stay in the stocks that are trending, and they're in strong sectors, and then hedging them a little bit with these inverse ETFs. ADM I added last week. That one still looks pretty good. Let me put the signals back on here. You can see. This looks like the correction. This was the move higher off the lows. Had this big pullback right here. This is an initial move up, so there's impulsive. It's corrective right here. Whenever you see a stock moving sideways, you want to pay attention to the direction it was moving in before it moves sideways. That's where it's more likely to go after it's done moving sideways. We'll see if that happens here. Sometimes you can get a little bit of a dip down. Bottom line is that this looks corrective. This looks impulsive right here. We should ultimately move higher off of this. I think my stop's down below here. If it comes back down here, I'm probably wrong, and I'll get stopped out. Now, this is my consumer staples trade, agricultural trade here. That sector has held up pretty well during this downturn. And then the SOXS is the chip ETF, which has gone way up again today. So that's where we're really making our money here. Now, this should be, I don't even have to look at it. Well, I'll move the screen down, but when I see that big of a move that quickly, we should be overbought. We should be at extreme reversal risk. Yeah, see. We're really overbought. So we're getting to a point where we're really due to have this thing pull back, which means a market rally. So, we're starting to see some of these extreme levels. But again, keep in mind that we could also become even more extreme. We could stay at the far. If we really start selling off right here, this thing could stay really extreme there for a few more days. So That's not saying that the market can't drop right here. It's just saying we're getting a little stretched. That's what we talked about. I'm not going to repeat what I talked about the whole last hour. We are a little stretched to the downside, but not enough where we couldn't go lower. All right, so that's what we're holding. Now, I don't think I'm going to do it today, but maybe we'll do it on Thursday. I do want to get another exposure in energy, but this time in coal. Let's take a look at it. So if you go to oil and energy, let's look under the hold section right here. I'm looking at adding maybe console energy, CEIX right here. Let's see what the chart looks like. Yeah, it's got an indecision candle today, so let's wait till Thursday to make that decision in case it pulls back a little bit further. But this is looking like a lot of the energy stocks were, in fact, this one didn't have that major pullback like the other ones did. It had this pullback right here. But so there's your ABC pattern right there. It moved higher. This looks like this wasn't an ABC where A, B, and C, but it's choppy. Notice how it's choppy as it's pulling back. It's kind of back and forth. It's kind of a corrective type behavior. And now it broke that downtrend here, and so it looks like it's starting a new uptrend. So I want to get some exposure to coal because I think coal is going to be in demand, especially in Europe. It's something that can be transported pretty easily, and so we'll see if that continues to move higher. But I want to wait for a little bit of. Wait, yeah, that's no reason to get in either from a signal standpoint. It had you could wait for this to go back to a buy signal as a confirmation, but I'd like to just see at least a bullish candle there, and I'm not seeing it. So I think we'll wait and look at that on Thursday. No rush, no reason to have to get in. But that's one that you could put in your watch list. Another one under oil that I liked was. The CVI right here. And this kind of, you remember the USO chart where it looked like we had like a larger ABC correction. And then looked like we were starting to move up. And then this looks like just like the USO chart. Again, indecision candle today, bearish kind of indecision candle. So I'd probably wait on that one too, but that chart looked pretty good to me. You could wait for it to go back to a buy signal too. It's not this can tell you how close it is to going back to a buy signal. It's right in the middle of the hold range, so it would have to rally up a little bit further here to get into a buy signal. All right, I'm going to leave it at that because it doesn't make sense to spend an hour talking about the market could go either way and then giving you 10 stock recommendations. Just, it's irresponsible to do that because I know some people are just they waited the whole hour just to have me just give out a ticker symbol and they're going to run and go buy it. Unfortunately, that happens, and I know it happens. It shouldn't happen, and it doesn't matter how many times I say don't go jump into this, wait for confirmation. I know people are just going to go buy it just because I say it, and that's never want to be like that. And you have to get beat up a little bit doing that before you realize you can't just go buy something because somebody says to buy something. You want to make sure you understand your trade, you understand your risk, you understand all these things before you make that decision. All right. So that's all we have for today. We'll see you on Thursday for the stock specific class. Have a good week, everyone. Bye now.